few reminders. This session is recorded. Keep your microphone on mute during this session, and we're on listen-in mode only. At any time when you have questions, please post them in the chat box that you see on the right. And the panelists will be happy to answer your questions later on in the program. Your feedback is important to us. After this event, we'll be sending you a survey. Please share your feedback with us. And if there's any other questions, please reach out to us at cs@rhtgoc.com. So let me introduce our moderator for today. Eric's our moderator for today. Eric is the Chief Business Development Officer of InCorp Global. He provides consultancy to local and foreign entities on the ideal market entry strategies for setting up or expanding operations in Southeast Asia. Eric also provides advisory to fund managers and family offices on structuring as well as applicable tax incentives. He has also set up many VCC structures for licensed fund managers. So it gives me great pleasure to introduce Eric to you, and Eric will now take over and have an introduction to the rest of the wonderful speakers we have today. Eric, over to you, please.
Thank you, Imelda. Thanks everyone for attending our live virtual fireside chat session titled VCC 2.0, What's Next for Singapore's Variable Capital Companies in 2031 and Beyond. So this event is proudly co-hosted by InCorp Group as well as RHTLaw Asia. So as Imelda has introduced, I'm Eric here. I'm the Chief Business Development Officer or CBDO of InCorp Group. Happy and very honored to be the moderator and host of the day. So today here with me, I have four fantastic experts who will be sharing with us their valuable insights as well as conduct a live discussion on all the questions that you as the audience have for the panel today. So before I move on to share on the model of the fireside chat session today, let's give our panelists some airtime for 30-second self-intro. Maybe let's start off with Eugene first, whose camera has some technical issue as I understand.
Thank you, Eric. Yes, just a quick intro. I am a partner at RHT Law, law firm here in Singapore, and I'm the co-head of the corporate and capital markets practice here. I've been working with Eric and InCorp quite a bit, on various exercises, including, of course, most recently in the last year or so, the setting up of VCCs. So we see an increasing trend in this regard, and we're very excited to share our experience today at this forum. I'll hand it over to the next person.
Thank you, Eugene. Maybe Tony?
Thanks, Eric. Hi, everyone. I'm Tony. I'm the Associate Director for RHT Compliance Solution. Thank you for inviting me to this session. I'm happy to share some of our experience working with VCC and InCorp. Just a bit of a background, RHT Compliance Solution provides compliance advisory to regulated license holder here in Singapore and the region. We've been working with Eric in setting up VCCs, and we'd like to share some of the things that we are experiencing in the recent months that we're seeing on VCC. Thanks, Eric.
Thank you, Tony. Benjamin?
Hi, thanks, Eric. Hi, my name is Benjamin. I head the tax department at InCorp. I've been in the tax industry for about 20 years, and in the past 10 years, I've been in the financial services space, and we have been actively helping companies set up VCCs in the past recent times. And I'll be happy to share whatever views we have from tax angle in this fireside chat.
Thank you, Benjamin. And last but not least, Vaven.
Hi, everyone. I'm Vaven. I'm a partner at Blauwpark Partners. We are a family office here in Singapore, and we hold a capital market services license for fund management, serving accredited investors. We also have an exempt financial advisor. Our model is a little bit different, and I won't kind of go too much into it. We operate in very single family office style, although we do have more than one family client. I think on the subject of VCCs and fund management and sort of my personal experience, I've been a regulator at the MES a long time ago in fund management. At the firm, we have set up 2 VCCs for our clients and also for our own use as fund managers to bring external third-party capital. We are speaking to more folks, and I think one of the large core families at our firm is not from Asia, they're actually from Europe. So quite happy to share more about our own experience and I guess the general attractiveness and some of the disadvantages of VCC implementation. I've also been an investor in the past, both on the buy side, looking at funds, and I've also been on the sell side. So happy to talk to those angles as well.
Thank you everyone for your self-intro. So let me share with everyone here today on the model of today's fireside chat. So we want to make this a very highly interactive session, right? Of which the panel experts, as you see here, right, answers the questions that you want to know or you want to be discussed on Singapore's VCC and VCC regime, especially in the theme of whether it will potentially morph and propel Singapore into a favored jurisdiction for funds and family offices globally in the future. Which is why we call it VCC 2.0. So at any time during this session, right, I'd just like to repeat again, please key in the questions that you wish to be discussed among the panelists using the Zoom chat function here in the application, and I will pick it up for discussion during this 1 hour session. So to start things off, right, as a warm up, right, while giving all of you some time to start keying in some of your burning questions that you want to be discussed here today, I'll just start off with maybe a couple of pre-prepared questions to start the ball rolling and also to let our panelists get some warming up as well. Maybe Vaven, we will start with you. I thought it'd be very interesting for the audience to hear from you as an experienced fund manager and MFO partner. So can you share with the audience here today, Vaven, on your consideration and decisions that you have made, right, when you, for Blauwpark Partners before you decide to set up the fund entity using the VCC structure in Singapore?
Thanks, Eric. It's a good question, and actually, I think it's quite a multifaceted answer. Actually, as a family office, we're a little bit different from, I guess, your more general partner or third-party fund manager, where you're actually kind of driving a lot of alpha, trying to optimize for process efficiency, tax efficiency, so on and so forth. I think in addition to all that, clearly as a family office, we like that as well. But I think there is an element for most clients of two separate parts. One is that the jurisdiction in which their capital is onshored is typically one where they would like the option to be able to reside and spend a lot of time in. I think Singapore as a nation, as a country, I think it's relatively common knowledge now. Most people like the thought of being able to spend time here. So I think this doesn't really sort of address the VCC structure in particular, but I think that's kind of where it starts for a lot of families. Moving into the VCC and then actually having a family principal or at least a family committee say we'd like to move the capital onshore, then tends to take three broad tracks. The first is it easy to do so? Are there clear cost, tax, especially tax and efficiency benefits of doing so? And in which case I think they're pretty clear. And the third one, I think, which is becoming a lot more prevalent, is the shift from previously you had a lot of onshore, offshore structures. So you had managers or decision-making bodies that were not in the same domicile. And I think increasingly, at least in the last 5 years, we've seen a pretty big trend where a lot of families are more comfortable with having the fund management capability in the same place where the asset is structured. So I think the typical answers of certainty of law, so on and so forth, are probably highest up on the list. But the VCC really comes into its own, at least in our standpoint, is, and again, principally because my clients tend to come from a European background, they're very familiar with the Luxembourg SICAV vehicles, the sort of overarching umbrella, multiple sub-funds. From a family office standpoint, this does two things. One, it allows unified governance for the entire family within a single vehicle, but it allows separation of asset ownership within the sub-funds. I think that's something that is very difficult to maintain in a cheap and tax efficient way without a VCC-like entity, especially if you want to do it onshore as an asset manager.
I see. No, thanks, Vaven. I thought later on, I'm sure a lot of audience will start asking you some questions on your other perspectives as well. Thanks, Vaven. So maybe Eugene, in your opinion, right, from the perspective as a lawyer, has the VCC been successful in Singapore since the launch in January 2020?
I would say so. I'm not sure I'll call it a runaway success, but it certainly has picked up quite a bit of momentum. I mean, if you look at the trajectory of its growth, I think they did a sort of health check around the third quarter in August of last year when they first started, and they hit about a milestone of 100 VCCs. And then Shortly after that, in a month or two after that, about another 25 came on board. And by the time of the end of Q1 of this year, it doubled. So now at the end of Q1, there were about 250. And as we speak now, we have already passed, we don't have the latest statistics yet. As we pass Q2, I am very sure by now we've exceeded 300. And if you think about it, I mean, we can't quite see exactly what the size of all of them are. But if you just take an average size of, say, around about, say, $30 million, which is quite conservative. I mean, of course, there are those who are probably smaller than that, but I'm sure there are those which are much, much larger than that, so it will just completely, move the needle. But if you just even take an average of 30-something million dollars, and if you have about 300, that's more than $10 billion. And that's a conservative estimate, more than $10 billion in assets under management using the VCC structure in a space of maybe 18 months, right, since the regime started. So yes, I think it's off to a good start. It is almost certain that the momentum will continue to pick up. And if we do a health check by the end of the year, it could well be significantly more than that. So yes, in summary, I think so far so good. Yeah.
Thanks, Eugene. And I guess that for the numbers that have that we are seeing till Q1 of this year, I mean, we have to take note that in 2020 it was launched in the midst of the pandemic, and even during the midst of the pandemic, the interest is still very high. So I think those are very strong figures. Thank you, Eugene. Hold on to your thought in that. Later on, we'll discuss more on what in the future, how would VCC morph into where MES takes a look or do a review. Maybe Benjamin, right, for the tax question. I think everybody here today may or may not have heard of the fund tax incentives such as the 13R or 13X that has been widely used to attract fund managers to domicile their fund entities in Singapore. So in your opinion as a tax advisor, right, in your many years of experience, do you think the fund tax incentive have contributed to the success of VCCs? Or is this the main reason? And the second part of the question is, do you think there are other tax advantages that the VCC can enjoy beyond the 13R or the 13X?
Yeah, thanks, Eric. I think the 13R and 13X incentives are not only a boost to the VCC, they are actually a boost to all fund vehicles that can apply for the incentives. But in relation to the VCC specifically, just some observations and how they complement with the VCC. As you all know, under the 13R incentive, there are some restrictions, investor restrictions, in terms of for Singapore corporate investors, how much of the interest they can have in a fund. So the threshold is at 30%. So in an umbrella VCC situation, whereby there are different sub-funds, these would contribute to a larger denominator, and it would make Singapore corporate investors easier to come in and not fall foul within the threshold and end up being a non-qualifying investor. And on the 13X incentive, again, on the umbrella fund, you can set up multiple sub-funds, and you do not have to apply for the incentive all over again in the case whereby if you did not have a VCC, and you only need to meet one set of economic conditions, the 50 million and 200,000 spending. So essentially, yes, the VCC complements the 13R and 13X incentive in that way.
Okay, so in that sense, the tax incentive have contributed to the success of the VCC in that sense. And what are the other tax advantages, right, for fund managers to consider if the fund vehicle or the VCC entity is in Singapore or domiciled in Singapore?
Well, on that question, well, I think we need to take a more macro perspective, I think the trend now in the fund space, we do see more, whatever jurisdiction it is, we do see more onshoreization of funds. And this is really partly driven by the BEPS initiative, whereby, there's a trend towards having the funds in the same jurisdiction as the fund manager, so as to create substance and not be looked at as if we are the funds are trying to take advantage of tax treaties. So driven by the BEPS initiatives, we do see a trend whereby a lot of funds are now domiciled in the same jurisdiction as the fund managers.
Sure. And maybe the last pre-prepared question for Tony because I see people posting questions already. So Tony, last prepared questions for you. I mean, fund managers are questioning this, right? Is maintaining a VCC entity more cumbersome compliance-wise versus the usual fund jurisdictions such as the Cayman or Luxembourg?
Thanks, Eric. I don't think it's more cumbersome. I think the structure of the VCC and the government has made it very friendly to attract funds into Singapore. And it's also no secret that Singapore's ambition to become the global hub for fund managers for VCs and PEs. So it's definitely not cumbersome. And I'm sure towards the later part of the discussion, you probably will share that MAS will probably come in to fine tune it when they have take a snapshot of how much of VCC has been set up here in Singapore.
Thank you, Tony. Okay, maybe let's start from questions, right, from the audience today. So first question from Joseph. So to the panelists, right, how have foreign, in specific European or American institutional LPs perceived the use of VCCs in Singapore for funds versus more traditional offshore structures? Evan, you want to start?
Honestly, pretty comfortable. I think it's more to do with lack of cultural familiarity. I think to a lot of Europeans, they've enjoyed a lot of extremely established processes and legal structures that they're used to. And I think, forget about Singapore, right? Even for Europeans looking at the US or North America or even Central Europe, for example, for Western Europeans can be a little bit of a challenge. So I think it's more just cultural familiarity. I think more broadly speaking, Singapore's rankings typically at the top of the governance rankings, the one that helps the most. With regards to more operational legal concerns, with regards to how assets are held, segregation, tax benefits and things like that, honestly, I don't think those are too high. People usually go, Singapore, it's fine. VCC, like a SICAV, quite happy to move. I think the only complication tends to be when you start talking about closed-ended fund investments, because the current VCC structure is very much geared for open-ended. So I think that's typically where people start to go, more comfortable, not so comfortable. We've worked with, we've actually invested in a closed-ended fund manager that uses a VCC structure here, so we got comfortable. But we're on the ground and not everybody is. So I think that's principally where the discomfort is. But other than that, as long as the service providers are industrial grade and we have them here, most people are comfortable.
Thank you. Anyone want to add on to this before we move on to the next question?
Yeah, maybe I can just add on. I think it also has to do with familiarity. I guess the offshore structures have been based for quite a number of years, and people are familiar with that. And VCC, it's only in existence for past 1 odd years. So I guess as it gets more as time goes by and people get more familiar, I guess it's something that people will be more open to.
Thank you, Benjamin. I mean, those are good points. Question from James, right? Do the panel think that the growth in the number of VCCs has been driven by the tax incentives or because of the VCC as a product itself? I thought this is a great question from James. So maybe Eugene, you want to comment since you've been doing a lot of applications as well?
Well, okay, but I'll leave the driven by the tax, whether it's driven by tax incentive to Ben to answer that one. But in terms of the product, I think the government has designed it to be, quite user friendly. It is quite flexible. I think the key features about it is, of course, the ability to distribute returns not out of accounting profits. I think that's one of the attractive features, unlike a private limited company. Of course, we are by no means the first jurisdiction to do that. Many other jurisdictions, most of the offshore jurisdictions, have that sort of structure. Another one is, of course, the ability to have segregated portfolios within the umbrella VCC structure, segregated sub-funds, where the assets and liabilities are insulated from each other. So again, that's something that I think a lot of fund managers are also familiar with, and it's not new. So I think an effort has been made to model itself after things which are familiar to people who set up similar entities, but it has its own features as well. I mean, in the sense that one of the, for example, requirements is that you must have a local licensed fund manager that is sponsoring and managing the fund, right? I mean, sponsoring used loosely in the terms of sponsoring the eyes of the regulator, not necessarily the one putting in the money, but the one that the MAS will hold accountable to. So that is something that is not present in other jurisdictions, or many other jurisdictions. And I think that is also something that they are having a look at. And when we talk a bit more later on, maybe about the VCC 2.0 proposals, I think there's some tweaking of that in the cards, possibly.
Okay, so in conclusion, you think that the product itself is attractive rather than the tax incentives?
I won't say rather than, but the product in itself is attractive. And I don't think the tax incentives take anything away from that, if nothing else, will enhance it. So I think the product stands on its own, can be fine-tuned. There are certain areas where I think perhaps, they haven't thought about how, the industry will use the vehicle. And now that they've received more industry feedback, they hopefully might take some of that on board and make it even more user-friendly. So I guess we'll talk a bit more about that later.
Thank you, Eugene. Maybe in terms of the tax part, I think I see another question when it comes to the current trending topic now. So I guess for the group of 20 or the G20, now that we have heard about the global tax reform, right, that's being led by the US, right? Global minimum tax of 15%. So there's one audience that asked, one of the member of the audience, is this a potential headwind? Though not directly in relation to VCC or the fund industry in Singapore, but I guess it does have a certain impact. So maybe Benjamin, you want to take this on? I mean, and the rest as well, and maybe Vaven as the fund manager. Do you think this will be a headwind for Singapore and VCC? Difficult question, I would say.
Vaven, are you going ahead?
No, go ahead, please, go ahead.
Yeah, I think the global minimum tax rate of 15%, that's has been hogging the headlines in the news and all that, which is agreed by the G7. That came about from the BEPS 2.0 initiative under the Pillar 2, and the objective of that initiative is actually to discourage MNCs from shifting operations to low tax jurisdictions and low pay and pay low taxes. But under that Pillar 2 initiatives, it's under the proposals that have been set out but not agreed yet by the OECD inclusive framework. It's not intended to cover investment funds. So I would say that investment funds would not be affected by that. But it does not exclude fund managers. So fund managers could fall within, would probably be impacted by it. on a more broader basis, how would that impact Singapore? Well, given the proposals and the rules involved in the complex reallocation of taxing rights and all that, I think the overall consensus is that Singapore might end up losing some of its tax revenues if that's implemented.
Thank you, Benjamin.
I think just
yeah, Vivian.
I don't think it's a sort of clear and present concern for us as a fund manager, to be perfectly honest. I think the reality is we pay our corporate income taxes as a fund management business here, anyway, and it's not too dissimilar from 15%, so no real change operationally. To families that have their assets here, I think many of them come from higher tax regimes, but at the same time, I think the big benefit for Singapore that they like is obviously the legal stability, security, and clarity of asset ownership more than anything. I think to kind of circle back to Eugene's earlier point, I think that the 13X R&C regimes existed before the VCC came to being. I think those created a lot of interest in Singapore as an onshore fund management domicile. The advent of the VCC structure was opportune. I think it allowed a lot of people to go, oh, I don't need to have a complex Christmas tree structure layer of private limited companies and try and figure out a way to get my 13X. And this is just an easier way to scale in. So I think those two things together have led to quite a lot of interest. And to be perfectly fair, one of the patriarchs of the core family that we work, one of the core families we work for, they've been here for 8 years. Having both these things in place is what pushed them across the line. But either one of them on their own would not have necessarily led to that decision.
No, I think that's clear enough. Maybe if you can move from the tax questions a little bit, maybe more to the legal structure side of the questions. One of the audience said or asked, as I understand, based on the current VCC Act, members of sub-funds are members of the VCC. Hence, they are entitled to receive the annual accounts or the audited accounts of the fund, which include the sub-funds that they are not members of. So, I mean, I guess this is within the zone of Tony and Eugene. So, when do you think this will be changed by MAS?
Yeah, I think if I may answer that, yeah, I think that is precisely one of the questions which are probably, if I would put my money on it, being debated within the walls of MAS right now. Because yes, at this moment, while assets and liabilities are segregated, information is not necessarily segregated. So in a sense, a member of one sub-fund, right, or investor into one, let's use the term investor into one sub-fund, actually does have visibility potentially on the other sub-funds as well. So I think one of the requests, industry requests, is in fact to actually silo the financial information in particular between the various sub-funds. And hopefully, yes, when VCC 2.0 comes out, that's one of the things that they will address and allow some form of segregation of information. So as to when that will happen, I think it will happen probably when they roll out VCC 2.0. And, you know, it could be as early as end of the year, knowing how quickly MAS moves, or even sooner than that. So I would be surprised if this proposal is not taken up, because if it's not taken up, then you might have to wait till the next cycle, the 3.0, which could be years down the road. And in the meantime, this is a feature that may cause some investors some pause, you know, as to whether they want to. It's not so much the investors. They're investors because other investors can view how their particular sub-fund is performing, so they may not be too comfortable with that. But we'll see. Yeah.
Sure.
Yeah, and I also want to add, I won't be surprised if MAS will put out a consultation paper much earlier before the year end, you know, just to get the industry's view on this. And I do share that Eugene's view that this change will probably be, you know, in the works coming in the VCC 2.0.
Yep, and I'm sure professional firms like InCorp and RHTLaw will contribute to that consultation paper. So this is one of the frequent points that fund managers around the world keep asking as well. So moving on to the next question, right? This question, are there any complications for offshore funds to re-domicile into Singapore using the VCC when it comes to tax issues or maybe potentially regulations issues? So maybe to the panelists.
Okay, maybe I'll just talk about, again, leaving aside the tax issue to our resident expert here. I think this actually deals with our redomiciliation regime here in Singapore. And I think that has been made quite friendly as well. So particularly for VCCs, because I think for a normal redomiciliation, in terms of, say, just some kind of a company wanting to redomicile here, there are certain sort of minimum threshold requirements for that. And so, for example, you need to have either assets in excess of Singapore 10 million or revenue in excess of 10 million or more than 50 employees. So you need to have 2 of the 3 requirements before you qualify for redomiciliation. This doesn't apply to VCCs. So that's the good thing. So you can actually redomicile. If you want to redomicile into a VCC structure, there's no minimum requirement. So, any size, any AUM or number of people, there's no minimum staffing requirements. So,
so the only requirement, Eugene, is actually to have a licensed fund manager to manage the VCC, yes, right?
That's right. Yeah. So that is one that I think there are other policy considerations at play as well. I mean, MAS is probably trying to grow our, local fund management, pool and expertise. So they're having this requirement, but of course, that's also being looked at least in certain aspects. Maybe we can talk about that a little bit later. Talk about VCC 2.0, but yeah, that's currently one requirement. Yeah.
And Benjamin, I mean, when it comes to tax issues, when it comes to redomiciliation, as a tax advisor, what would you advise?
Generally, for redomiciliation, the benefit is that for redomiciliation, if the entity suffers any exit taxes when it's redomiciled, typically in Singapore, you can claim a credit for the exit taxes paid. So that in a way encourages the redomiciliation of the entity into Singapore. And there are also some rules around the expenses that are incurred and when there's write-backs and all that. But the key point is around the exit taxes, whereby you can claim a foreign credit for that when you redomicile into Singapore.
Sure. I have another interesting question. Can the Singapore-based fund manager of a VCC appoint a non-Singapore-based sub-advisor to help or manage the investments in the sub-fund? I think this is a regulatory point of view as well.
Okay, I'll attempt to answer that question. Well, I don't know how public this forum is, or do Chatham House rules apply to this discussion here, but all of us who are involved in the setting up of VCCs and talking to clients involved, well, I mean, we all know that at the end of the day, the people who really have the expertise to manage a particular asset or asset class in a particular sub-fund, they're not necessarily the fund manager that is actually sponsoring the VCC as such. So to some extent, but I mean, again, there's nothing new and there's nothing unusual in the sense that the fund manager often does engage, sort of specialist experts to actually manage certain aspects. There's nothing new there. And I think looking at the question, I don't think there is a prohibition, against something like this. But of course, at the end of the day, who is answerable to MAS? It's your licensed fund manager.
Yep.
So if somehow that particular sub-fund goes belly up, and all the investors lose their pants and they lodge complaints and all that.
Yeah, the fund manager will get it. Yes.
Exactly, and his license is at stake here. See, so in a way, he needs to also do his due diligence, be very comfortable with whoever he's appointing or whoever is being suggested to be appointed, in order to mitigate risk for himself, for itself. Yeah.
Sure. Vaven, Tony, you want to add on? I see Vaven smiling.
I mean, as Eugene points out, this is a fairly sort of commonplace concern operationally. I think for us as a family office, one of the benefits of a VCC structure, and this is a point which we discussed, I think, on a pre-call as well. We have set up 2 separate VCCs. One is actually focused entirely on structuring for family beneficiaries. That VCC then actually looks to invest in another one, where we actually then do it according to asset classes and product types, because this is where we commingle. If they are friends of the family, who are accredited, obviously, that's all we can work with, want to co-invest along with the family in certain things. Sometimes certain members of the family would like to run their own micro fund. They'd like to do something a little bit different. They'd like to obviously invite their friends and earn a bit of fee and carry. And then, you need to start exploring sub-advisor type arrangements and setups, especially if they don't necessarily want to come to Singapore, work here, live here, and be a regulated person, because all they want to do is the analysis, and then obviously the fund managers do the rest. I think for us, we've tried to keep it pretty tight, where the investment committee decision-making, the risk committees all sit with the fund manager for everything that we do.
Yep.
I think maybe more conservative than most on that front.
Thank you. Maybe another question. There's a question that comes to, since we are talking about accredited investors, right? So one audience is asking, does the accredited investor concept apply to the VCC? Are there qualifications for investors in the VCC?
I think the simple answer there is sure, of course. In fact, I would say that, in fact, so far in our experience, the VCCs that have been set up have very much been targeted at accredited investors. I think it makes sense, right? Because the compliance requirements are that much lower. I mean, we go out, with a information memorandum or private placement memorandum, not have to do a prospectus, because and if you want to reach out to retail investors, the requirements are much more stringent. So it probably doesn't make much sense to do so. So it's definitely I think, in fact, I would even venture to say that it's quite geared, in fact, for the accredited investor market, because also it's a fund management tool, right? So a lot of these family offices and all that is set up here, or wealth managers, it is to manage monies of accredited investors. I hope that answers.
Yeah, and I guess the term AI is also in conjunction with the fund license, right? And depending on the fund license that the fund manager obtains, can they deal with AIs or can they deal with retail investors? So that's a different concept. So when we're talking about retail investors, right, I think there's one member of the audience is asking the differences, right, or the advantages between a private unit trust versus a VCC structure. So which structure is better or will prevail?
I would say a VCC is a legal entity that is maybe not as complex, or to some extent, some aspects more complex than a company, but you've got an entire regulatory regime governing how it's supposed to operate. Whereas a private trust or even unit trust, it's much more open-ended, right? I mean, it's constituted by a trust deed, and then it's the terms governing it, are all basically contained in there. There's not much regulatory oversight over the structure. So some people might feel that, which is why people before the VCC, they'll use corporate structures. And then when you have things like LPs, coming in, they also move towards that, because all these are structures that are, governed by a statutory regime. unlike a trust, which is very light touch as far as the statutory regulations are concerned. Yeah.
No, I think that's answer to the great point as well. The legal entity type and the features of it, which plays a part or consideration for fund managers. I can see that we are approaching 5 o'clock now, but I thought it'd be good if I can pick up one last question from the audience, if you can post it here, before we end it off with a discussion about VCC 2.0. So any questions from the floor? Maybe I'll take one more question. Okay, since there's no more question, maybe that was one came in from Amanda. So among fund managers with different types of licenses, right? Be it the LFMC, RFMC, or the VCFM, is it that the VCFM license is it ideal to manage the VCC due to its restrictions on being able to manage closed-ended funds? So essentially, the question targets at particularly the VCFM license holders. Is it ideal for them to manage the VCC because more often than not they're just managing closed-ended funds?
Yeah, I'm trying to understand because it seems a bit more like a statement than a question as such. Yes, I mean most VCCs, I think so far being structured are structured as open-ended investment vehicles. It can, in fact, of course, be structured as a closed-ended vehicle as well. And in fact, there are certain benefits to that. I mean, I can think of one exemption, for example, if it fits certain requirements, including managing a closed-ended fund, then there may not, in fact, be a requirement for a custodian. I think that is one of the exemptions inside the VCC Act that I'm aware of. So it can definitely be used for a closed-ended fund. But whether a venture capital fund management license holder is not ideal to manage a VCC, I wouldn't say so, because if it is intended to be a closed-ended fund with limited or controlled entries and exits, it fits a private equity structure, right? I mean, it's not a unit trust type structure. People come in and out, redemptions daily, not that kind of structure. So I wouldn't say it's not the venture capital fund manager is not suitable to manage a VCC. It depends on the VCC, right? And if he's setting it up, of course, he's going to set up something that is suitable for his use. So it's more how the VCC is.
It's being structured, yeah.
Yes, it's quite flexible in that sense.
Yeah. No, I'm the moderator, but for this question, I thought the VCC is ideal for a VCFM license holder. It really depends how the fund is being structured, how the constitution and the PPM looks like, and how you're going to position it to your investors, right? So to that question, I'll say, yeah, it won't be not ideal because it's venture capital focused. So maybe to round it off, we're at 4:50 now.
Yeah, a little bit there. I think this is probably to the VCC 2.0. Trying to do both open and closed-ended structures under the same VCC gets complicated.
Yes, that's right. That is complicated. Yes,
we have grappled with because
yeah, that would be complicated. So as a professional firm, we'll usually tell the client set up 2 VCCs. One is open, one is closed. Yeah, so that would be probably a better choice of structuring it rather than putting it under sub-funds or under one umbrella. Okay, so maybe a ending question for the panel here today, since we're talking about VCC 2.0 as well. So in your personal opinion, right, are the current regulations in Singapore sufficient to make VCC the favored child globally, right, versus the usual fund jurisdictions? And in your personal opinion, as a build on to the earlier questions, how will VCC 2.0 look like in the future?
Okay, maybe I'll just opening remarks to that. I think, I mean, if you talk about MAS or Singapore firing an arrow, first arrow that they shot out of the bow, I think the 80% it's there. If the end target is to make Singapore the most favorable jurisdiction in the world, for setting up these structures. I think that arrow flew about 80% of the distance, which is not bad for a first shot. But has it hit that target? Not quite. And this is precisely where these tweaks in different aspects possibly can come in this 2.0 that might just, allow it to close that extra 20% and kill the competition. At least structurally, legally, and everything. Of course, from a reputation-wise, it's still got some way to go, but that's nothing new. I mean, we tend to be a bit sometimes Singapore-centric. We think everyone knows about us, but that's not true because we talk to people actually located in, say, jurisdictions like the Mauritius and all these places, and really they've not heard of it. They've not, and I think if there's one job that perhaps Singapore needs to do, and what we all can do, is to spread the word more to some of these other jurisdictions, because there are people there who are actually willing to give us a shot if they know more about it. So it's a PR exercise, not a regulatory exercise. But I think we are getting close, but not there yet, and there are different aspects to be tweaked. I won't, I'll let others have a chance to cover some of these aspects, really. So by all means, yeah.
Yeah. Thanks, Eugene. Thanks, Eric, for that question. Whether the VCC is the favorite child, I think, looking from what Eugene shared, the response we got so far has been very encouraging, and 2.0 will probably tweak it better to what Eugene has covered. Another 20% of it, to achieve what the VCC intend to. So yeah, we definitely see some changes, and that would definitely pivot us to be closer to be the global hub here in the region.
Thank you, Tony. Vaven, Ben?
I agree with Eugene, actually, that a lot of it's speak about clients onshoring capital in Singapore. A lot of it, actually, probably 70% of the time we spend educating them about the VCC and drawing parallels with similar structures that they're used to. I think the VCC 2.0, I think from a family office standpoint, and I think for a lot of high net worth investors, the segregation of information requirement is probably the one that's most critical. The vast majority of high net worths do not really relish the prospect of their participation in any sub-fund being shared openly across with every other sub-fund. I think that's probably the biggest one. The broader attractiveness of Singapore and the VCC regime to families in particular, I think the broader struggle is not with the VCC. I think it's actually with the cost and perceived quality of service providers here, principally with on the administration, custody, and brokerage side. To be perfectly blunt, it was quite a big challenge for us. Without the 13X, we would not have convinced European clients to come over, because notwithstanding we are supposedly young and new and green and no legacy, it's a lot cheaper there. It's just a lot cheaper.
Thank you, Vaven. I think you brought up important points earlier on. Ben, on
from tax angle, I think to be the favorite child, I guess we all need to look around and see what's the competition around the world is. I mean, like, for example, I understand in Hong Kong, there are new rules that introduce around exemption of carried interest for private equity. So, and that's something we don't have in Singapore, and the treatment of private equity is somewhat nuanced in Singapore. So definitely, I mean, if we can come up with other concessions and improve what 13R and 13X has already done, I think it would be great to, and with the tax rules complement what the infrastructure of the VCC, definitely together as a package, I think we can stay ahead of the competition with the VCC product.
Yeah, I thanks to all of the panelists. I guess to sum it up, it seems like VCC 2.0 will definitely be enhanced, and MAS is in the works of doing so to tweak it around. And I think for the audience here today, if you have not already set up your VCCs in Singapore, in terms of looking at the features and attractiveness of the VCC regulations itself will be something that's key to you. Tax incentives as well is key to you, but you have to, I think what Vivian and Ben were saying as well is you have to look at it as an overall package that Singapore brings as a country. So in that sense, there's multiple factors to consider that would likely make VCC 2.0 or even 3.0 very successful. And in terms of the future, right, if MES opens up the VCC for family officers as well, all right, I think that will also be a game changer. And I see Eugene nodding his head as well. Yeah, for family officers.
I think that is the biggest wish on the wish list. That's number one. That really simply opening up the structure to single family officers. I think. I mean, there's no inability to do so. It's just whether government as a policy,
whether they want it. Yes.
They want it, yeah. If they want it, it will flood in. There'll be no doubt about it. It's a question of whether they want it. So we'll see.
Agree. I mean, many clients are asking me the same things as well. So, but again, to sum it up, I think Vaven has dropped off here, some technical issues. But to everyone who are joining us today, thanks again for your time, for this 1 hour of your time to listen to the panel, to discuss on several points when it comes to the VCC and its potential future. If you have any questions post this seminar, I mean, I don't think I managed to answer everybody's questions. Feel free to write in to us. You can write into any of the panelists here, including myself, in the mailbox that Amelda has shared earlier on InCorp's website, or even on RHT Law's website and RHT Compliance Solutions website. You can also find our personal contact points as well. If you want to get in touch with Vaven to get his insight as an existing fund manager, MFO partner, again, his contacts are also available on our Blauwpark Partners website as well. So thanks again, everyone. We are signing off now. Thank you very much.
Okay. Thank you. Thanks, everyone.
Panelists. Thank you.
Bye-bye.
Thank you for
Bye. Thank you, everyone.